One of the questions that I get regularly is how do you guys know that your data is predictive and that the natural language processing model that you guys are using is predictive? And so, what I'm going to show you today is some of the analysis that we do on a weekly basis, or one of the reports that we generate on a weekly basis that looks at the performance, excuse me, of our data over the prior week. So I get this report every Monday, and I'm going to share some of it with you. So October 10th, 2022. And this chart here is the cumulative performance year to date of securities that have an S score of 2 or higher, meaning the current conversation is 2 standard deviations more positive than normal prior to market open, and the subsequent open to close return for stocks in the $5 and higher universe. And the green line is the year to date performance of stocks that have an S score of 2 or higher. It's the open to close return prior to market open. And then the red line is the universe of securities that have an S score of -2 or lower prior to market open and their subsequent open to close return. And so what you're seeing here is that securities that have a positive S score 2 or higher, they go on to outperform. Securities that have an S score of -2 or lower, they go on to underperform. In this case, a negative return is positive alpha because theoretically you would short those securities. And then the black line for comparison purposes is the S&P 500. Now, the SMA universe is about 4,500 US equities, but we put the S&P in there just for comparison. And the blue line here is a theoretical long short portfolio. So in this case, if you went long the green stocks and short the red ones, or long the green line, short the red ones, and compounded that, this is the return you would have gotten year to date. So to read this table, the S score of 2 or higher is positive 8.84 year to date. That means you buy at the open, sell at the close. You have no overnight risk. Those stocks would have returned 8.84. That's not accounting for commissions and slippage. If you shorted the stocks that had an S score of -2 or lower prior to market open, and you shorted open the close, a -21, that's positive alpha because those stocks went lower, and you would have a theoretical long short of 36.98% compounding that versus the overall open to close return of the S&P 500 of a -13.3. Here's your sharp, here's your sortino. As you guys all know, a sortino doesn't penalize you for volatility in the direction, so at 1.1 and -1.81, and that long short has a Sortino of 8.23. Now, this is just this week's report. And what we typically do is we compare it to last week's report. And you can see there are a lot of tables. We have year to date, we have cumulative return. So here's last week's report. So in this case, the longs, or the S score greater than 2, went up significantly. So we went from 5.69 to 8.84. And then on the short side, they went -21 last week, and this week they're negative 21, 21.33. So again, the shorts went lower, and then your long short were in this case the S&P last week -14, -3, so -14, -13 this week. So in this case, the S&P went up a little bit. So this is just a quick example of some of the things that we do to look at the performance, the predictive nature of our data on a weekly basis. Thank you.